What I want to do in this video is to touch briefly on the subject of the currency rates, and what determines the changes in the currency rates. Most of us, if not all of us, actually have come across this word currency. So I will not really delve into the details of what currencies are and everything. I just want to go straight into what determines the changes. You find that the currency of a country may depreciate or may appreciate, and this is in comparison with other major convertible currencies. For example, our currency in Zambia, the kwacha, we may want to compare it to the US dollar and how it's performing. Usually we take keen interest in the changes in the currency rates because of the issue of trade. For example, if I want to import a vehicle from abroad, I'll be looking at, okay, how much is our currency trading at? How much am I going to spend? And things like that. So the currency may change from time to time, but what really determines it? There are several factors. Number one, there's an issue of inflation, the inflation rates. In simple terms, inflation really refers to how expensive or how cheap goods and services are in a particular economy or a country. For example, to simplify it, say for example, if I want to buy some fruits, order some fruits from Zimbabwe across the border, and it happens that the fruits in Zimbabwe are much cheaper than here in Zambia. What will happen is that that country's currency will be strengthened due to more traders going that side to buy those fruits and bring them here in Zambia. Why? Because of the low prices in the fruits that side, traders will prefer to go and order that side. So they will take forex that side, and by doing so, they're strengthening that country's currency. So inflation will determine a country's currency. In an economy where prices are relatively high, you'll find that even the currency will really be low. It will be depreciating. The second factor is the issue of interest rates. And our interest rates are actually very related to the issue of inflation as well. But in simple terms is when interest rates are high in a particular economy or a country, you find that investors will bring in their money and invest in the economy. Why? Because they know that their returns on those investments will yield much higher profits because of that rate, which is much higher compared to another economy which may have relatively low interest rates. So interest rates are another factor that will determine how strong or weak a country's currency is. The other factor is the issue of what is referred to as balance of payments, or a country's current account. Now, to simplify this, really, think of two countries, Zambia and South Africa. If Zambia imports more from South Africa, than it exports to that particular country, you find that we'll have a deficit in the trade, or a negative, or an imbalance in that sense, in terms of what we sell, what we export to that particular country. Now, because we are spending more on the imports, it means we're taking more money that side to South Africa than we are actually earning through sales, through exports. So the issue of the balance of payments also has an effect on a country's currency, and this is at a macro level in most cases, really. And governments are very sensitive to these issues, and they pay particular attention to such issues. The other factor that contributes to changes in the currency rates is the issue of government debt. In simple terms, if a country owes or has a huge debt, it owes so many lenders, it means that the space for it to borrow money from outsiders is limited due to this huge debt which it has to repay. So because the government cannot borrow, or it has limited space where it can borrow money, it means there will be no forex coming into the country. And what that means is that it will limit the amount of money circulating in the economy, and that will lead to depreciation of the currency of that particular country. So government debt is another factor that contributes to that. The other aspect is we talk of issues of political instability or political stability. Say, for example, if investors are anticipating, or they're anticipating that probably, or they're seeing that the situation in a particular country is not very stable political wise, they'll choose to withhold their money and not invest in, because of the hostility in terms of the political climate. So because they will hold back the money, it means there will be no investment coming in the country, and that ultimately results into the currency weakening. Apart from that, there is an issue of speculation. The issue of speculation, this generally refers to the general mood around, which is going around concerning a particular economy. If investors or players in the economy are expecting that maybe there will be some natural disasters or a calamity or floods or earthquakes or something like that in a particular economy, or civil strife, investors again will withhold their money. They will not invest their money in the economy. So you can see now that there are several factors actually that that contribute to the changes in the currency rates of a particular country. It's not just the inflation, the common ones, or interest rates. There are other things such as what I've mentioned there. So it's important to understand the basics of these factors which affect the currency rate, because when you have an understanding of this, you can choose to make prudent decisions about your business, whether to invest more or to wait to hold on to your money. And this will make sure that you are not caught off guard, because you are well informed about the situation, economic situation regarding to the currency rates. So once more, thank you very much for watching and listening, and as always, feel free please to subscribe. There are more videos of this nature, and I hope you've gotten one or two things.